Gold spiked to nearly $5,600 an ounce this year. Then it crashed below $4,000 in months. Behind that wild ride is a quiet, decade-long bet China is making against the dollar itself. By the end of this episode, you'll understand exactly what's happening, why it matters, and what's genuinely still uncertain. This story runs from a Shanghai trading floor all the way to the US Federal Reserve. Gold, the dollar, and a decade-long strategic shift. Let's go through it properly. Picture an ordinary retail trader in Shanghai. Earlier this year, gold was on an incredible run, climbing toward $5,600 an ounce. Apps and bank products made leveraged gold trading easy, and stories of quick money spread fast. Then the correction came, a drop of nearly 30% in a matter of months, turning leveraged bets into real financial emergencies. In response, China's largest banks acted. The Industrial and Commercial Bank of China, the world's biggest bank by assets, announced it would stop offering retail precious metals trading linked to the Shanghai Gold Exchange after July 24, 2026. Postal Savings Bank, Ping An Bank, and China Guangfa Bank quickly followed with similar moves. Here's the nuance headlines often miss. This isn't a ban on gold trading in China. Physical gold purchases remain completely unaffected, and so do non-leveraged options like accumulation plans and ETFs. The Shanghai Gold Exchange itself continues operating normally for institutional participants. This is specifically about the retail-facing leveraged products banks were offering as intermediaries. Banks tried tightening the screws before exiting entirely. Margin requirements on gold trading were raised as high as 140%, meaning you'd need to put up more collateral than the trade was even worth. At that point, leveraged trading stops making sense, and banks decided to close the business rather than keep managing the risk. This tightening didn't come from nowhere. It traces back to 2020, when a Bank of China product linked to oil futures blew up spectacularly. Retail investors ended up owing money they never expected to lose when oil prices briefly turned negative. Since then, Chinese regulators have taken a consistently firmer stance against retail speculation, and this gold shutdown is really the final chapter of that multi-year campaign. Here's where the story gets much bigger than one banking policy. This retail crackdown is just the visible surface of a far quieter, more consequential shift. China steadily repositioning its entire reserve strategy, away from the dollar and toward gold. While retail traders were getting shut out, China's central bank was doing the opposite. The People's Bank of China has extended its gold buying streak to 17 consecutive months, pushing its officially reported reserves past 2,300 tons, now roughly 9% of its total foreign exchange reserves. At the very same time, China has been steadily reducing its holdings of US Treasuries, down to roughly $683 to $693 billion today, the lowest level since 2008, compared to a peak of over $1.3 trillion back in 2013. China's share of all foreign-held US Treasuries has fallen to around just 2%. Why the sudden urgency? Trace it back to a single event. In 2022, the West froze Russia's central bank assets in response to its invasion of Ukraine. That single act sent an unmistakable message to every other government holding dollar reserves. Those assets aren't unconditionally safe. They can be frozen for political reasons at any time. Gold's appeal in this moment is precise. It's a non-sovereign reserve asset. Nobody can freeze it, sanction it, or weaponize it the way a dollar-denominated bond can be. For any country worried about being on the wrong side of a future political dispute, that single property makes gold worth paying a premium for. And this is the part that surprises most people. This is not just a China story. Russia's gold reserves have grown roughly 4.5-fold since 2008. Poland doubled its gold share of reserves between 2015 and 2022. Turkey nearly doubled its own between 2019 and 2024. This is a broad, global stampede toward gold, not a single country's maneuver. Put a number on it. Central banks worldwide have bought over 1,000 tons of gold a year since 2022, roughly 3 times the historical average of the prior decade. This is one of the largest shifts in how governments manage their reserves since the current monetary system began. This isn't a one-off either. In the latest survey of central banks worldwide, 89% said they expect official gold reserves globally to keep increasing over the next year. This is a broad, shared conviction across both advanced and emerging economies, not a fringe bet by 1 or 2 governments. Here's why all of this matters enormously for America. The U.S. runs large, persistent deficits, financed by continuously issuing new debt. China was historically one of the largest buyers of that debt. As China and others pull back, the U.S. has to find other buyers or lean more heavily on the Federal Reserve itself to absorb the debt, which raises its own inflation risks over time. It shows up in the data already. The DXY index, which tracks the dollar against a basket of major currencies, has fallen to some of its lowest levels in years. Some of that reflects this global reserve shift, but importantly, not all of it. Part of the dollar's rough stretch is domestic, not foreign. Public tension over who leads the Federal Reserve next, and how independent that decision truly is from political pressure, has unsettled some investors. This is a genuinely contested live debate. Reasonable people disagree on how serious a risk it actually is. Here's a strange asymmetry. The U.S. holds about 8,133 tons of gold, still the largest reserve in the world, but carries it on its books at a statutory price of just $35 an ounce, a figure from the 1970s. At today's market price, that same stockpile is worth roughly $1.16 trillion. The country building the current system is quietly sitting on a massive, unmarked-to-market asset. This is the real strategic insight. The yuan has a trust problem. China maintains capital controls, and few countries want to hold a currency they can't freely convert or trust the political system behind. Gold has no such problem. It's been treated as reliable across every civilization for millennia. By anchoring the yuan to gold, China borrows that trust rather than trying to build it from nothing. This isn't just rhetoric. China has built real infrastructure. New gold contracts on the Shanghai Gold Exchange, with physical delivery vaults now available in Hong Kong specifically for international clients, let foreign holders of offshore yuan convert directly into physical gold. That's a concrete, usable mechanism, not just a policy announcement. And it's already showing results, at least domestically. The yuan is now used for 52% of China's own cross-border payments, compared to 43% for the dollar. A real, measurable shift in how China itself settles trade, even if it hasn't yet translated into major global reserve currency share. Put it all together, and China isn't just hedging for itself. It's positioning itself as the neutral infrastructure provider, the exchanges, the vaults, the settlement systems, for any country that shares the same fear of having its dollar assets frozen or weaponized. That's a much bigger ambition than simple currency diversification. But here's the pushback worth taking seriously. Despite real progress, yuan trade settlement, China's own cross-border payment system, a digital yuan, few countries are voluntarily choosing to adopt Chinese financial tools at scale. Building the pipes is one thing. Getting the world to actually want to use them is proving to be a much harder problem. Keep this firmly in perspective. The US dollar still accounts for roughly 57% of global foreign exchange reserves. The yuan's share remains in the low single digits. Whatever is happening here is a genuine, real trend, but it is a trend measured in decades, not a dethroning that's already happened. Here's a genuinely ironic wrinkle. The instruments actually seeing strong organic global adoption right now are dollar-pegged stablecoins, especially across emerging markets, not China's own digital yuan. Even as governments diversify away from the dollar at the official level, ordinary people and businesses seem to be choosing dollar-linked digital money when given the option. So, does any of this mean you personally should rush into gold? That's genuinely not something we can answer for you. It depends entirely on your own goals, time horizon, and what else you hold. What we can say factually, gold pays no yield. It can be highly volatile even in the short run, as this year proved, and it has historically served more as a diversifier than a growth engine. Whatever you conclude about the dollar or the yuan specifically, here's the durable lesson underneath all of it. Every currency, including the dollar, ultimately runs on confidence, in institutions, in rule of law, in the promise that it'll be honored. Gold's whole appeal, for 3,000 years, has been that it doesn't need anyone's promise at all. Let's pull it together. China's banks ended retail leveraged gold trading, a real consumer protection move, not a full ban on gold itself. Underneath that headline, China has spent years quietly buying gold and selling US Treasuries. This is a genuinely global trend, not just China. Russia, India, Poland, and Turkey are all doing the same. China's deeper goal is using gold's ancient credibility to give the yuan a trust the world doesn't yet extend to it directly. But the dollar still dominates global reserves by a wide margin. This is a slow, multi-decade shift, not a sudden dethroning, however it's sometimes reported. So we've seen how confidence, not gold or paper, is what actually holds any currency up. That raises the obvious next question. What actually happens to a country's economy the moment that confidence genuinely breaks? Not gradually, but all at once. That's exactly where we go next. If this gave you a real grounded understanding of gold, the dollar, and China's long game beyond the scary headlines, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow. See you in the next one.